Alright, in this first example we have a master budget of Windy Company that has a planned activity level of 50,000 machine hours. They've given us some detail totaling a manufacturing overhead of 1.26 million, and they've said that a flexible budget for level activity of 60,000 machine hours would show what costs. So the first things what we'll do is we will identify the costs as indicated. So we've got a total of manufacturing overhead of 1.26 million, and there's a unit of 50,000 planned production. We're told that the labor is indirect, so it would not matter on how many hours. The materials are indirect at 210,000. Depreciation of factory building would not be impacted by production. You could, however, consider that machine supplies could be variable based on production. If in this example our machine supplies were variable, and being the only one, we would have a total of 1.296 million. Based on the options available, I would strongly suggest in this case that machine supplies were not driven based on consumption of those machine hours. So you could argue that machine supplies were general maintenance regardless of usage of that machine. So I would in this case suggest that the total costs for 60,000 machine hours would remain at $1.26 million. In the second example, we have Devlin Manufacturer making a single product, and they have the following information. They have variable costs, and they have some fixed costs per month. And we're asked to determine the amount of manufacturing costs for a flexible budget level of 3,200 units per month. So in this case, we've got to identify our variable versus fixed costs. So we have 650 per unit direct, 240 direct labor, 110 for manufacturing overhead, and then some fixed costs at the bottom. So we have a total manufacturing cost fixed of 21,300. If we take our units, being 3,200 units, multiplied by the direct materials of 650, our monthly costs would be 20,800. Our monthly direct labor would be 240 times the 3,200 to be a 7,680, and our manufacturing overhead would be a total of 3,520 per month, for a total variable cost of $32,000 per month. Adding our fixed costs being 21,300, we have a total of $53,300 per month for this budget. Alright, for situation 3, we have wind production. They use a flexible budget, and they're giving us information from the budget for March in which 3,000 units were produced and sold, and appear below. We have direct materials, indirect materials, salaries, depreciation, direct labor, and property taxes. So that being said, it's asking for us the flexible budget component for 4,000 units. So we have to go through the list and identify what was variable. And in this case, we only have direct materials being a variable, indirect materials being variable, direct labor. So we have a total variable cost. In that situation, based on the March information provided, we had total variable costs of $30,000. Divide that by the 3,000 units produced, there's a $10 per unit variable cost. Extrapolating that out, at 4,000 units, we will have total variable costs of $40,000. If you add that to the fixed costs, being the supervisor salaries, depreciation, and property taxes, you would then get the budget for a 4,000 unit month. Situation 4, we have got Most Corporation reported the following items for 2016. They've got controllable fixed costs, contribution margin they've told us, interest expense, variable costs, and total assets. What we're asked is to compute the controllable margin for 2016. So we want to populate what we know, and we know what the variable costs are, we know what the contribution margin is, and yes, so we'll populate that up. So we have the $80,000 in variable costs, we have the contribution margin of 122, less the controllable fixed costs, being 77,000 we're told. We can then complete the division income statement by determining what their sales were by adding the contribution margin to the variable cost to have the gross number of 202, and therefore will result in a controllable margin of $45,000. Alright, in this example we've got the owner of a toy manufacturing company. They recently expanded their business in order to add an additional product line, and they now have a minimum rate of return of 11%. So we're told for toys versus shirts, they had sales of 600,000 and 200,000 respectively, with controllable margins accordingly being $120,000 and $10,000. They have average operating assets of $900,000 and $200,000 for each division, and we're asked to compute the residual income for both centers. So in this situation, if our expected minimum rate of return is 11%, multiplying the average operating assets by that expected minimum rate of return, subtracting that from the controllable margin for each of the two investment centers, we have toys having a residual income of $21,000 with a residual loss actually in the shirt department of $12,000. Alright, we've got this Floors Direct organization, and we're given some information about its flooring division for 2016, where we had sales at a level, controllable margin, variable costs, and our average operating assets. And we're asked to calculate the required rate of return, the residual income based on a required rate of return of 10%. So if we pull in the relative information here, we would start with sales being a $4 million volume. We have a contribution margin, or a controllable margin, of $250,000. And we have a 10% minimum on our average operating assets required rate of return. So 10% of $1.8 million is $180,000. Subtracting the $180,000 from the $250,000 controllable margin, they have a residual income of $70,000 for the hardwood flooring division. In this next situation, we have a company planned activity for the next year to be 100,000 machine hours, and they created the following budget, and we've been given the split between variable and fixed components. We're asked then to prepare a flexible budget based on 90,000 machine hours level of activity. So in order to determine this calculation, first of all, let's pull in the relevant information for the variable costs. Indirect materials at 90,000, labor at 120, factory supplies at 15, being variable costs. And then we have fixed costs of depreciation, taxes, supervision, for total manufacturing costs of $300,000, based on 100,000 units. Being told that the variable costs only are these first three items, we would then take the first three items divided by the 100,000 units times the 90,000 units. So if you look in this formula here, it is equal to the 90,000 divided by 100,000 units times 90,000 units, otherwise 90% of the original start, is $81,000. Applying that to the other variable costs of indirect labor, that would give us 108, factory supplies at 13,500, and our fixed costs would remain the same. Our total manufacturing costs then would be $277,500, being option C in this example. Alright, in this situation we've got Chain Industries. They prepared a fixed budget based on 60,000 hours, giving us variable overhead of $300,000, fixed overhead of $90,000, for a total overhead of $390,000. What we're asked to do is determine what the budget would be based on 57,000 hours instead of 60. So in this case we would take our variable overhead costs divided by the number of units times the revised number of units, being 57,000 hours. So our total variable overhead cost budget would then drop to $285,000 plus the fix of $90,000 for a total of $375,000, being option B. Alright, we're told in this situation that Chambers uses flexible budgets, and at normal capacity of 16,000 units, they have budgeted manufacturing overhead of $64,000 variable and $180,000 fixed. If they had actual overhead costs of $250,000 for 18,000 units produced, what is the difference between the actual and budgeted costs? So what we need to do first of all is determine what the base budget was. So we had variable overhead costs of $64,000, fixed of $180,000 for a total of $244,000 against units of 16,000. We're told they use flexible budgets, and we know that their units produced dropped to 18,000. So we'll take the variable overhead cost, being 64,000, divided by the number of units in the core budget times the actual units produced. So our variable overhead flexible budget amount would be 72,000. Fixed overhead would not change, giving us total overhead cost budgeted flexible of 252,000. They had an actual cost of $250,000, giving a $2,000, in this case, favorable balance. They were under budget by $2,000, being option B. Alright, this example talks about a company with 18,000 direct labor hours. They had a flexible budget for materials of $36,000, 36 for 18,000 units. If they had $37,000 incurred and change for 18,400 hours, what would their flexible budget report show? In order to determine that it is unfavorable of 600, we need to determine what the flexible budget is. The flexible budget would be the indirect material cost being flexible, 36,000 divided by 18,000 units times 18,400 actual consumed would be 36,800. Less the 37,400 actual incurred gives a $600 unfavorable variance. Question 11 says we're given an excerpt from the management performance report with the following information. There's a budgeted contribution margin of $1 million with an actual of $1,050,000. They have controllable fixed costs budgeted at $500,000, but actual controllable fixed costs came in at $450,000. And we're asked to determine the manager's overall performance. So if we break this down, we look at the contribution margin being $1 million, less the $500,000 controllable fixed costs, gives them a controllable margin of $500,000 budgeted. If we look at what actually happened, they had a contribution margin of $1,050, less the $450 controllable fixed costs. Their actual margin went up to $600,000 versus a budget of $500,000. We're told that the manager's overall performance equals the controllable margin difference, so the difference in these two numbers, divided by the budgeted controllable margin. So in this case, it is a 20% above expectations. That is, they earned 20% more controllable margin than was expected. And that's all we have for some walkthroughs. Take care.